in the book. SE5, Sean Michael invested $10,000. What are we going to do there with Sean Michael? Invested $10,000. I'm sorry, what? Debit cash. What else are we going to debit? Or excuse me, credit. Okay, this is SE5. Sean Mike, for each transaction, indicate which account is debited and which account is credited. So what is debited? Cash. What is credited? Capital. May 5th, purchased a computer for $5,000 in cash. What is debited? Equipment. An asset. What is credited? Cash. May 7th, purchased supplies on credit for $600. What is debited? Supplies, the asset. What is credited? Accounts payable is credited. The liability increases. May 19th, received cash for programming services performed, $1,000. What is debited? Cash. What is credited? What? Yes, revenue is credited. May 22nd, received cash for programming services to be performed. Hasn't been performed yet. What is debited? Cash. What is credited? Unearned revenue. It's a liability. It's something we have yet to perform the obligation for, don't we? It's a liability. May 25th, paid the rent for May 1300. What is debited? Rent expense. What is credited? Cash. Because remember, the normal balance of an asset is a debit. When you reduce an asset, you credit it. And cash is getting reduced because we're using it. Next, May 31st, we billed a customer for programming services performed. We billed them. What is debited? Accounts receivable. We billed them and we sent them an invoice. We haven't received the money yet, but accounts receivable means we sent them a bill. We expect the money soon. What is credited? Revenues. Does that make sense? No? Okay, we'll keep going. We'll keep going.
Just to know where it's at, like revenue or accounts receivable.
Sure. Okay, so let's just keep going here. On July 10th, Blue Design Studio performs a service for an investment advisor by designing a series of brochures and collects a $2,800 fee in cash. Recognition is July 10th. Valuation, $2,800. Classification, what is being increased or debited? Cash. What is being credited? Service. Design revenue is being credited. Revenues have a normal credit balance. So what we're doing here is we increased our cash or debited it on July 10th for $2,800, and our owner's equity, design revenue, is increased. Remember, revenues increase our owner's equity or capital account, and expenses and withdrawals decrease our capital account, don't they? So do you see our journal entry? Cash is debited, $2,800. Design revenue is credited, $2,800. So do you see how every journal entry, we have a corresponding journal entry with the transaction in the T accounts here. On July 15th, Blue Design Studio performs a service for a department store by designing a TV commercial. The company bills for the $9,600 fee now, but will collect it later. Did they perform the service? On July 15th, they performed the service by designing it. So we can record the revenue when it was earned. They billed them $9,600. What are we going to increase? Accounts receivable for $9,600. What are we going to credit? Design revenue or commercial revenue for $9,600. So as you see here, our revenue or our asset goes up $9,600, and our design revenue also goes up $9,600. But when revenue increases, we credit it. When assets increase, we debit it. Okay? It's important, I would do a cheat sheet, and I would have assets, the normal balance is a debit, equals liabilities, the normal balance is a credit. Owner's equity, the normal balance is a credit. Revenues increase owner's equity, don't they? So the normal balance is a credit. Withdrawals decrease owner's equity. So to decrease owner's equity, what are we going to do? Debit. So withdrawals have a normal balance of a debit, but it decreases it. And expenses decrease owner's equity, so they're going to have a normal balance also of a debit. I would make a cheat sheet. So you can look at that until it clicks. Not a cheat sheet, but you get it. Here's another one. On July 19th, Blue Design Studio accepts a $1,400 advance fee as a deposit on a series of brochures to be designed. Have they been designed yet? Have they earned the revenue? No. So which account is going to increase? Cash for $1,400. What else is going to happen? What will be credited? Unearned revenue of $1,400. That liability will also be increased. Unearned design revenue is a liability account. Liabilities have a normal credit balance. Is that right?
So would that be like two separate cards in the ledger, like revenue and unearned revenue? Or
Absolutely.
Or is it all just
Nope. Perfect. Revenue is one account. It's a revenue account. But unearned revenue is what kind of account? A liability. So they're two separate accounts, and they get recorded in separate places. Okay?
But they're both credited?
They're both credits. You're exactly right. One is a liability, and one is part of owner's equity. Okay? And they're both credited. But one's a liability, and one's an owner's equity. Here's another one, guys. On July 22nd, Blue Design Studio receives $5,000 cash from customers previously billed on July 15th. So what's going up here? Cash is being debited. What's being credited? Accounts receivable is an asset, isn't it? And it's going down because they got the money. So in this scenario, both are asset accounts. One is going up and one is going down. But assets still equal liabilities plus owner's equity because our assets are just being changed here, right? Our assets, on the cash goes up 5,000. Another asset account, accounts receivable, goes down. But it doesn't change the overall equation, does it? Next, on July 26th, Blue Design Studio pays $4,800 for 4 weeks of employee wages. So these wages have been fulfilled. Now Blue Design needs to pay the salaries. What happens here? Cash goes down. Expenses go up. So as you see here, our cash of $4,800 gets decreased or credited. But our owner's equity section is also getting decreased because we're paying an expense. But our wage expense goes up. But whenever we pay out a wage, what happens? Owner's equity ultimately goes down. So do you see our assets went down $4,800 and our owner's equity also went down $4,800? One is a credit and over here it's a debit. Remember, normal liabilities and owner's equity have a normal credit balance when they go up. But when they go down, what happens? Wages expense is a debit. On July 30th, Blue Design Studio receives but does not pay the utility bill that is due next month for $680. What's happening here? We received a utility bill. What account would that be? Utility expense and accounts payable also. Why? We owe money, don't we? So our utility goes up, doesn't it? Our utility, our accounts payable goes up, but our owner's equity ultimately goes down because we're paying another expense. So do you see here? It's on this side of the equation. Our liabilities get increased, but our owner's equity gets decreased. Do you see how it didn't change the side of the equation? One part got debited, one part got credited. Utilities expense is debited, and our accounts payable is credited. On July 31st, Blue Design Studio withdraws $2,800 in cash. What's happening here? We're doing what to? Debiting withdrawal. And what are we crediting? The cash. We have the withdrawal account gets ultimately increased because it reduces our owner's equity. Our withdrawals account gets debited because it's reducing our owner's equity. And the cash is also getting decreased because we're crediting it. Do you see here our cash is credited $2,800? And our J Blue withdrawals is also debited $2,800. So here's a credit, here's a debit. Do you see how they're both equaling? Yes? J Blue withdrawals gets debited. Our cash gets credited. Now we have gone through all these transactions for the month, guys. We have really performed accounting. We have created, analyzed the transactions from documents. We've recorded the journal entries. We've posted them to the various T accounts, haven't we? And now what we're going to do is create a balance. Do you see how we added our debits in cash? We added our credits, and we come up with a balance of cash of $22,480. Accounts receivable, we added our debits, we added our credits, and the difference is $4,600. Our office supplies, we just had one transaction. Prepaid rent, one transaction. Office equipment, one transaction. If we take all of our assets and total them up, our assets equal $51,800. Then we go to our accounts payable and we total our debits, we total our credits, and we end up with a credit balance of $62.80. We also have another liability account called unearned design revenue of $1,400. If we take our two liability accounts, we end up with a credit balance down here of $76.80. Now the hardest part is our owner's equity, because right now we're taking our revenues, our income statements, and right now we're keeping them in owner's equity. So we start with J Blue Capital. We have a credit balance there, $40,000. We had J Blue Withdrawal, a debit of $2,800. We're going to take our design revenues, total them. Then we've got two expenses that have debit balances. So if we take the design revenue minus our expenses, that technically would be our net income, wouldn't it? And remember how we put our net income in the capital section? So really what we're doing here is we're getting more detailed, and just instead right now of showing just the net amount, we're taking our revenue accounts minus our expense accounts, and the difference is going in our capital, along with the equity, the capital invested, minus any withdrawals. So if we take our $40,000 minus our $2,800 plus our $12,400 minus our $4,800 and our $680, we get $44,120. Because really our revenues of $12,400 minus our expenses of $54,80 equal $65,20, right? I'm doing something wrong. Yeah, $65,20. So if we take our $40,000 plus our $65,20, subtract from that our $2,800, I might be off somewhere, but we end up with $44,120. So do our assets equal our liabilities plus our owner's equity? Now let's do this. The following accounts are applicable to Kathy's Nail Salon, a company that provides manicures and pedis. We've got these various accounts. For Kathy's Nail Salon, enter the number corresponding to the proper account for each debit and credit for the following transactions. The first one, made a rent payment for the current month. We're going to debit rent expense, aren't we? We have rent. Expenses have a normal debit balance, so we're going to debit account 8, and we're going to credit cash of 1. B, received cash from customers for current services. What are we going to debit? Cash, number 1. What are we going to credit? Service revenues, 6. C, agreed to accept payment for next month from a client for current service. So we're not going to get paid right now. She promises to pay us next month. So instead of our cash increasing, what's going to increase? Accounts receivable, number 2, will go up or be debited.
Wasn't she accepting the payment?
No. She's basically
Oh, no.
she's basically showing it's going to be received next month. What gets increased? What gets credited? Revenues, service revenues gets increased or credited. D, purchase supplies on credit. What happens there? Does it get debited or credited? Yes, it gets credited. What gets debited? Supplies. E, purchased a new chair and a table for cash. What gets debited? Equipment gets debited. What gets credited? F, made a payment on accounts payable. What gets debited? Accounts payable. What gets credited? Good, guys. This is awesome. Now, guys, what we did is if we go back and take these accounts, do you see how we have cash? A debit of $22,480. Do you see we have accounts receivable, a debit of $4,600? We have office supplies, a debit of $5,200. Prepaid rent, a debit of $3,200. Office equipment, a debit of $16,320. Accounts payable, a credit of $6,280. Unearned design revenue, a credit of $1,400. J Blue Capital, a credit of $40,000. J Blue Withdrawals, a debit of $2,800. Design revenue, a credit of $12,400. Wages expense, a debit of $4,800. Utilities expense, a debit of $680. If we take all those accounts and put them all together in one piece of paper, and we list our debits together, and we list all of our credits together, this is a trial balance. The trial balance is only to show our debits equal our credits. Now, you see our cash, all of our assets have debit balances. Our withdrawals have a debit balance. They should have a normal debit balance. And do you see how our expenses have a debit balance? All of them total $60,080. Do you see our accounts payable should have a normal credit balance? Our unearned design revenue is also a liability that has a normal credit balance. Our capital account has a credit balance. And our revenue account has a credit balance. Our debits equal our credits. After we're done at the end of the month recording all these transactions and then totaling our balances, the first step is to create a trial balance after we've posted everything. This is a trial balance. To list every account and to make sure our debits equal our credits. Does that make sense? Yes? So in preparing a trial balance, we're going to list each account that has a balance with debit balances. We're going to put in the left column because a debit means Left. And a credit means list the accounts in their order. We start with our assets, then we do our liabilities, then we do our owner's capital, then we do our withdrawals, revenues, and expenses. We add each column, and they better balance, right? The trial balance proves whether the accounts are in balance. It doesn't detect if we have an error. It just makes sure our debits equal our credits. If the debits and credits in a trial balance are not equal, then there might be a reason. Maybe a debit was entered wrong as a credit, or vice versa. The balance of an account maybe was balanced wrong. Do you see the math errors? Thank God for computers. We could have just screwed up bringing the numbers over. So there could be all kinds of reasons our balances don't equal. But the purpose of a trial balance is to make sure our debits equal our credits. I'm not going to worry about that right now. Okay. Go take one. I'm so sorry. So Highland Design Company creates radio and television advertising for local businesses in the Twin Cities. Troy, I'm sorry I don't have one for you. I did, and they're not here. I'm going to give them to one of you guys. It creates radio and television advertising for local businesses in the Twin Cities. The following alphabetical list shows Highlands Design's account balances as of December 31st, 2014. So it gives us our account payable, our accounts receivable, our cash, our design revenue, our loans payable, rent expense, our meta capital, our meta withdrawals, telephone expense, unearned revenues, and wages expense. Our job is to put various accounts, record them as an asset, liabilities, then we've got our meta capital, our meta withdrawals, revenues, and we have 3 expense accounts. So the first thing we're going to do, does your T accounts, does it show the breakdown of the accounts, or do we have to fill them in on your sheet of paper there? It does break it down. So we know there are 3 asset accounts. What are the 3 asset accounts? Cash, accounts receivable, perfect. Cash, accounts receivable, and equipment. And so what we're going to do is, well, let me go back here and sign in again. So we're going to have, and then what's in our liability accounts? Accounts payable, notes payable, unearned revenue. Then we have our meta capital is on its own. We know there's a withdrawal account. We have a revenue account. And then do we have, how many expense accounts? 3. And what are the expense accounts? Rent expense, telephone. Perfect. So now, guys, our job is to take those balances, and we need to go, this is 2-1, yeah, I don't have a thing for it, and we need to go and put them into the appropriate locations. What do we know about asset accounts? They all have what kind of balance? The normal balance is a debit. So you go and let's take all those assets and let's fill them in. So basically what I'm going to do here, actually let me save this and then download it so it's bigger. DCTC principles. So the balance of cash is how much? 15.4? 18.4. So where are you going to place that? As a debit or a credit? Perfect. How about accounts receivable? And that's a debit? What's the next? Okay, so let that go. What else? Accounts payable. All payables have a normal balance of credit, so that's going to fall under a credit. What's next? Loans payable has a normal credit. What's next? Unearned revenue will have a credit balance of, perfect. Now, capital. Then a normal capital account has a what balance? Credit balance. And so that's going to go on the credit side, right? What's next? Withdrawals. What are you going to do there? Debit it. What's next? Revenues. Revenues have a normal credit balance, don't they? Expenses have a normal debit balance. What's next? What's next, guys? Oh, that's the wrong one. I get it. What about the expenses? You're going to put in the appropriate place, right? Then sorry, I'm trying to pull this up. So then as we move down here, well, it's back. I need to flip it, so let me just get in here. Oh. Trying to find where I put the thing. Principles. Okay, there I go. Let me bring this down. P1. So I need to flip this. View, rotate view, clockwise. Okay, So do you see here, guys? Right now we should have in our assets, we don't have equipment yet. We don't know equipment. Ignore that $49,180. We have our cash and our accounts receivable. We have all of our liabilities in the credit side. We have our capital of $74,000. Our withdrawals are a debit of $36,000. Our design revenue of $210,000, and our expenses in debits. What we're going to do, we have to figure out how much the equipment balance should be. So how are we going to figure that out? We know assets equal liabilities plus owner's equity. So let's figure out our liabilities. If we take the $64,20 plus the $10,000 plus the $18,000, what do we get? We get $34,420. Okay, now let's take our owner's equity. Our owner's equity is $74,000 minus $36,000, because those are our withdrawals, plus the revenues of $210,000 minus our expenses of $11,880 minus $960 minus $124,000. $135,880, $136,840. Should be $136,840. So if we add this, the $74,000 plus the $210,000, subtract from that the $36,000, the $11,880, the $960, and the $124, what do we get? $111,160 plus our liabilities of $34,420 should equal $145,580, don't they? Now, assets equal liabilities plus owner's equity. So our assets need to equal also $145,580. We know our cash is $18,400. Our accounts receivable are $78,000. Don't we add those together and subtract it from $145,580, and that's got to be our equipment? So our equipment has to be $49,180 because assets equal liabilities plus owner's equity. Does that make sense, guys? Okay. I am going to do the quiz. I'm going to help you. Don't freak out. We're doing it together. Nothing's changed. How do I make it bigger? Normally I have a little roll thing I can make. What? Okay, so let's look at number 1. Who wants to take number 1? Someone read number 1. Read the choices.
Inventory, cash, trademark, or supplies.
Okay, is that your final answer? Number 2, someone else. Now, if we're going to do this, everyone has to contribute. Number 2.
Which of the following accounts is not considered an
Is that your final answer?
Yes.
Everybody agree? Are you sure? Really? Next. Is it easy so far? Number 3. Oh, I'm taping this.